Hello, this is Mark Spitz with Spitz Legal Counsel. Today I'd like to talk a little bit about a question that I frequently get from clients, and that is whether their limited liability company, their LLC, should have a written operating agreement. My answer is almost always yes, you should. It's very important to have an operating agreement. One of the great advantages of a limited liability company over a traditional corporation is its flexibility in how you structure it, in how it's managed, and how you deal with some of the issues that come up in the life of the company. Now, if you don't have an operating agreement, then the state LLC statute governs, and you may not always like what it says regarding some of those aspects of managing and running the LLC. So what are some of the things you should have in your operating agreement? First, you can set out how the LLC is to be managed. For example, if you have designated managers of the LLC, you can set out what they have the authority to do. Do they have the authority to hire and fire employees? Do they have the authority to enter into contracts, enter into a lease, take out a loan, and so forth? You can also set out what key decisions members rather than managers have to decide on. For example, to sell the LLC, to take on new members, or to take on substantial obligations like a large loan or to buy property. So you can set out what managers have the authority to do and then what members are required to give their consent for. Another aspect relates to taxes. Now, in the operating agreement, you can require that the LLC distribute enough of its income so that members can pay their taxes. The reason for this is that under IRS rules, if an LLC has profits at the end of the year but doesn't pay them out, the members still have to pay tax on their share of those profits. So if there's no agreement or requirement that the LLC pay out enough for members to cover their tax obligations, there may be disagreement as to whether the LLC should do that, and members have to go elsewhere to find the money to pay their tax obligation. Another very important thing that an operating agreement will deal with is transferability of interest. Each member has an interest of some percentage in the LLC, and suppose the member wants to sell his or her interest, or suppose an outside buyer comes and approaches a member and offers to buy that member's interest. In the operating agreement, you can set out the restrictions and requirements for transfer of a membership interest. So, for example, if a member wants to sell or if they get an offer from an outside third party, the operating agreement can require that that member first offer his or her membership interest to the other members. That way, the remaining members don't have to worry about one day waking up finding that a member has sold his or her interest to somebody who the remaining members don't know, maybe they don't like. If they do know them, they don't necessarily want to do business with an outsider. So that's a very important aspect of an operating agreement, to deal with who's going to be a member, and if a member wants out, under what terms that member can exit. You can also deal with the death of a member or the disability or a divorce and require what happens in those situations. So these are just some of the very important issues that an operating agreement should deal with and the members need to address. Without that, you're at the mercy of the state statute, and it may not read the way the members want. So for that reason, I almost always tell people, yes, you do want an operating agreement in writing that deals with these critical issues. So if you have any other questions, please contact me at Spitz Legal Counsel. Thanks.